Why does one small interest rate affect your loan, your credit card, and your savings all at once? By the end of this video, you will understand how interest rates actually work, how they quietly shape your daily money decisions, and what you can do to protect yourself when rates move up or down. Let's be honest, most people hear interest rates and tune out. It sounds technical, distant, like something that only matters to banks or governments. But interest rates show up in everyday life. You feel them when your credit card bill grows faster than expected. You notice them when loan payments feel heavier. You question them when your savings earn almost nothing or suddenly earn more. Interest rates decide how expensive it is to borrow money and how rewarding it is to save money. And when they don't change one thing at a time. They move through the entire system together. That is why people feel pressure, even without doing anything wrong. The rules around money shift quietly, and unless you understand those rules, it feels random. Today, we are going to slow this down and make it clear. What interest rates really are. At the simplest level, an interest rate is the price of money. That may sound abstract, but it shows up in real life every single day. When you borrow money, interest is what you pay for using someone else's money over time. When you save money, interest is what you earn for letting someone else use yours. It's the same idea viewed from two different sides. Think of money like a tool that can be rented. If renting that tool is cheap, people use it more. If renting is expensive, people become careful. When borrowing money is cheap, people feel comfortable taking loans. They buy homes, start businesses, invest in education, or upgrade their lives. When borrowing money becomes expensive, people hesitate. They delay decisions, they cut back, they become cautious. Here's a simple way to see it. You take a loan. The interest rate decides how much extra you'll pay on top of what you borrowed. That extra cost is the price of time. You keep money in savings. The interest rate decides how fast that money grows over time. Why does this matter to you? Because interest rates quietly decide how heavy or light money feels. They influence how confident people feel about spending, how comfortable they feel saving, and even how willing companies are to hire. Many people believe interest rates only matter if you take large loans. In reality, they affect everything that depends on money moving through the system. That includes wages, prices, job security, and financial stress. Once you understand interest rates as the price of time, their impact becomes much easier to see. Interest rates and loans. When interest rates rise, borrowing becomes more expensive. Not suddenly, but steadily. Monthly payments increase, payoff timelines stretch longer. Budgets feel tighter, even when income stays exactly the same. This pressure builds quietly, without warning. Imagine two people taking the same loan for the same amount. One borrows when interest rates are low, the other borrows when interest rates are high. Everything else is identical. Same loan, same income, same lifestyle. Over time, one person pays significantly more than the other. That difference has nothing to do with discipline or intelligence. It's about timing. Why does this matter? Because higher interest rates reduce flexibility. When payments rise, you have less room for emergencies, career changes, or unexpected expenses. A small disruption that once felt manageable suddenly feels overwhelming. Many people believe once a loan is taken, the interest rate no longer matters, but this is not always true. Many loans, especially variable rate loans and credit-based borrowing, adjust as interest rates change. That means a loan can feel light one year and heavy the next without you doing anything. Understanding this helps explain why loans sometimes feel manageable and sometimes feel suffocating, for reasons that are not immediately obvious. It's not always about earning more or spending less. It's sometimes about how expensive time has become. Interest rates and credit cards. Credit cards are where interest rates changes hit first and hit hardest. When interest rates rise, credit card rates usually rise almost immediately. And because credit card balances roll over from month to month, that interest compounds quickly. Here's what happens behind the scenes. You carry a balance. The interest rate increases. More of your monthly payment goes toward interest before it ever touches what you actually owe. You're paying, you're trying, but progress feels slow. Sometimes it feels invisible. Why does this matter? Because credit cards turn small delays into long-term costs. A few months of carrying a balance can stretch into years when interest rates are high. The higher the rate, the longer time works against you. Many people assume making minimum payments means they are moving forward. In reality, minimum payments mostly protect the lender. They keep your account active while interest continues to grow. This is not about being irresponsible. It's about understanding how fast interest works when rates are high. Once you understand this, credit card frustration stops feeling like a personal failure. It becomes a math problem shaped by time and rates. And once you see that clearly, you can make calmer and more informed decisions instead of blaming yourself. Interest rates and savings. Now let's look at the other side of the system. When interest rates rise, savings usually earn more. When rates fall, savings earn less. On the surface, higher rates sound like good news for savers, but timing matters. If inflation is also high, your savings may still lose purchasing power, even while earning interest. Your balance grows slowly, but the prices around you grow faster. That's why many people feel confused. They are saving regularly, their account balance increases, but life still feels more expensive. Why does this matter? Because savings feels safe, and safety feels like progress. But safety and growth are not the same thing. Savings are designed to protect access. They are there for emergencies, short-term goals, and peace of mind. They reduce stress, they create stability, but they are not always designed to build long-term value. A common misconception is earning any interest means you are moving forward. The correction is simple. Interest must grow faster than rising prices to truly increase value. Once you understand this, you stop blaming yourself for doing the right thing and still feeling stuck. You realize that savings and growth serve different purposes, and both are important for different reasons. Making interest rates useful in real life. Now let's make this practical. Firstly, understand what type of debt you have. Fixed or variable matters more than most people realize. Fixed debt stays predictable. Variable debt changes weight as interest rates move. Secondly, treat high-interest debt like an emergency. The higher the rate, the faster it drains your future money, even if the balance looks small. Time works against you more aggressively when rates are high. Thirdly, don't confuse saving with growing. Savings protect access and stability. Growth depends on timing, rates, and how money is used. Fourthly, expect interest rates to change. Don't build your financial life assuming today's conditions will last forever. Build flexibility instead. Review your interest rates regularly. Adjust spending early while changes are still manageable. Avoid ignoring interest rates until payments become painful. By then, options feel limited and stress feels high. If you only remember one thing from this video, remember this. Interest rates decide whether time is helping you or hurting you. When you understand how interest rates work, money stops feeling random. Decisions feel clearer. Stress feels more manageable. This is educational, not financial advice. If you want more calm, practical money explainers, subscribe. Comment below and tell me which one affects you most right now. Loans, credit cards, or savings. In the next video, we'll break down the easiest way to start investing. Money becomes easier once you understand the rules.